Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
We want to bring in the head of the world's biggest active bond manager, Pimco. They began making, earlier this year, making a case for actually owning treasuries in that 5 to 10 year zone as it saw, get this, unpredictable U.S. policy furnishing the appeal of high quality bonds, at least compared to equities as well as to corporate debt. And so far, that bet has paid off. You see that in the returns in the bond market relative to equities. For a closer view of that market and the signals it may be sending, pleased to say that Manny Romaine joins us right now, CEO of Pimco. Great to have you, Manny.
Thank you for having me.
Market disruptions, market perceptions have changed a lot, really in the last 4 months, because I felt like in January, coming into this year, people were relatively optimistic.
That's correct. I think people had made the assumption that there'd be a very quick resolution to the tariff question, and the reality is there's a lot we don't know, but that tariffs are going to be high and that we're going to have to deal with it for a long time, and that we'll need to readjust our thinking, both in terms of economic growth but also inflation. I think that's the real question we have to deal with.
Can you make that change now, meaning like when you have to factor in what economic growth will be, what the impact of tariffs will be, even though we don't know, how do you make that pivot now?
I think you do scenario analysis. The big three trading partners are China, Mexico, Canada. So you basically run simulation and say, if this happened, then this will be GDP. If this happened, this will be inflation. And acknowledge that we don't know what the end game is going to be. And the only thing we can reasonably say is the overwhelming likelihood is you will have high tariff for the foreseeable future. And we'll have to deal with this.
Manny, once we know what the terms are, does some of the uncertainty go away and things settle down? But it's structurally a different financial dynamic potentially, depending on how high those tariffs are?
I think that's right, but I think a number of companies will have to re-engineer the supply chain and optimize the production costs and the transfer pricing based on what the tariff will be. And I think that changing supply chain may not be as easy as what you make it to be. For us, we look at a set of macro parameters and optimize our portfolio and decide what we think is attractive in terms of asset and buy them at the best possible price.
So what does that mean for investors? Do they just kind of stay put, waiting for everything to settle? Or are they starting to make those bets, assuming it is going to be very different? Tell us a little bit about what you are seeing in terms of flows and so on.
I think you've seen enormous volatility in the equity market.
Right.
And somehow I would say we're surprised that the equity market has bounced back to the Liberation Day level, but you've seen clearly a move to cash. Our world, which is the bond world, has been pretty much unaffected. And my partner, Dan Iverson, has this say where you look at the yield on a portfolio of bonds, say 6%, 6.5%, it's a very good predictor of what your return will be over the next 5 years. So if you want to own bonds, you're going to make 6.5%, give or take, over the next 5 years. How you're going to get there? A lot of uncertainty.
Well, that's what I'm curious is about the volatility. And I mean, you're referring to your CIO. I mean, I saw an interview where you actually talked about how he was really embracing that volatility to a certain extent.
So there's two components to it. What we like about volatility is the fact that it will provide investment opportunity and a source of alpha in terms of trading different part of the curve, but also different product, and to move away from the US and find opportunity in other part of the world. So you can always buy US asset, but you can also buy non-US asset as a way to get duration and hedge them back into dollar. So for example, we like Australian duration. Australia has a very robust economy. We like Australian bonds, but we hedge them back into dollars.
Yeah.
That's a way to add alpha to the portfolio.
How complicated is it to do that when there's also a ton of volatility in the FX space and no one seems to know where the dollars might be going?
You may wonder what the 2,000 people we have in Newport Beach do. That's what they do. We could deal with that. Just about,
Fair
but
enough,
we could deal with that.
Listen, U.S. Secretary of Treasury Scott Bessent obviously really kicking off Milken on Monday, and he talked about the importance of watching the 10-year. Do you agree in terms of U.S. Treasuries?
The cost of borrowing is very important, and I think I will answer this in twofold. One, the U.S. dollar as a reserve currency is really important, and the 10-year bond is in a way the barometer for the financial health of the world economy. So it is really important. Now, I would say you look at the whole yield curve. You look at the short end, the 10-year, the 30-year. You think also about credit spread. They're very tight. And you think about all of these parameters and try to assess what's to come and how you're going to deal with it.
Manny, one thing I'm curious about, and bringing up Secretary Bessent, what is the voice that you listen to most in trying to determine ultimately what happens in the U.S., especially when it comes to its financial system and the importance of, it's been the place, the world's safe haven, right?
And it will remain as the place of safe haven.
You're so sure. Why?
Well, think about it. The US dollar is the reserve currency, but it's also the most liquid treasury market in the world by an enormous factor. And yes, you can make a reasonable argument that the dollar is slightly expensive and that you may want to diversify from the dollar to other currency. But it does not mean that the dollar loses its status. And I think it's very important to keep that in mind. There's no other reserve currency. There's no other place to move trillions and trillions of dollars away from the dollar. And it is what it is.
Do you have faith in the Treasury Secretary to do the right thing, or at least get the president's ear on doing the right thing? Because he has said some things in regards to the Fed, the Treasury Secretary even. So I'm just curious, do you have faith?
I think the wonderful thing about financial markets is that they're efficient. And
so they'll tell them.
And that the market reacts to policy.
Yeah.
And when the market doesn't like either policies or a tweet, the market reacts in such a way that people need to adjust the course of action. The market wants the Fed to be independent, and I think has voted very strongly about that. And I think that dictates some of the choices and some of the noise around all of this. And it's a good thing. Markets are there to reflect supply and demand, and also reaction to events in the world.
And we saw that play out in a big way in April. One side of that, though, but basically to your comments about their kind of this being the most liquid market, this is kind of the reserve currency, and that's not going to end. Will it lessen to a degree? Because when we look at our treasury market and we think about how many global investors hold our bonds, all the rumors that maybe certain nations might be willing to weaponize their holdings if the dispute with the U.S. over trade escalates, does that concern you?
There's no free lunch. The reason why people own U.S. dollar is because they like to own U.S. dollar asset. There is a very strong case for American exceptionalism, the fact that the financial systems are very liquid and very well run, and that if you, for example, a Japanese investor where there's about $1 trillion of U.S. debt held by a Japanese institution, it's a good place to be, even hedged back in yen. And I think that's really an important fact to remember in terms of the flow of fund and who needs to put money where.
Is the treasury market healthy right now?
Totally.
You weren't concerned at all about what transpired that first week of April, about a potential gum up in the system or that mismatch between buyers and sellers?
No, on the contrary, I think we've seen very liquid market, both in treasury and in credit. And to be honest, markets have been remarkably well behaved.
Yeah.
We had a couple of difficult days during COVID before the Fed intervened, but it's been very smooth sailing since. And, the markets offer plenty of opportunity to change your mind. One of the good contributions have been ETF, where ETF have allowed people like us to do portfolio trade, to rebalance our book, and to use this liquidity to move assets around. And I would really emphasize this: the markets are quite liquid.
I promise not all my questions are pessimistic, but I do have one more. With regard, you had a market that had to deal with the trade issues. That hasn't been resolved, but they certainly made some degree of peace with where we are. There's now a big budget battle that's about to take place in Washington. And I do wonder, as the leader of the biggest bond company, bond investor out there, is there concern that our fiscal deficit and the potential remedies that are being discussed in Congress could exacerbate the situation in the fixed income market?
That's the wonder of being the reserve currency. Everything else being equal, you can run a slightly higher deficit than you would otherwise. And I think that, of course, people will look at the amount of deficit and it is overwhelmingly likely that the deficit is not going to get reduced. But once again, would you rather own very high quality assets in the US, or would you rather own bonds in Southern Europe? You can decide which one you would rather own. That's the reality. The reality is you need to invest somewhere.
So you're not worried about, it's a lot of debt, the fiscal situation. It's been a lot of debt for a long time, but now we're at levels we haven't seen. And so I'm just curious, is there some point, it sounds like you're saying, well, where else are you going to go, right? And it's kind of part of the U.S. being the market in the world. So, should we just accept it?
No, I think I would reply with a quote that I heard Janet Yellen give in a private conversation.
Yeah.
She said, all we can say is it's not a problem until it becomes a problem. And so, but it's a deeper meaning maybe that it appears. There's a tipping point, which is very hard to guess, where all of a sudden, either because the issuer loses credibility or because the policy doesn't make sense to market participants, people all of a sudden don't want to be the marginal buyer. And I think that's the analysis we constantly make in terms of what's the right level to clear the market.
Manny, when we had the disconnect between the equity market selling off a bunch and we saw yields spiking, right? We were trying to make sense of it, right? It just didn't seem to come together. Are you telling investors, watch the bond market? Equities kind of do, how do you make sense of something like that?
Well, you could say that it did make sense because the market all of a sudden said, we're going to get in a worst possible situation. We're going to get into stagflation.
Right.
And in a case of stagflation, I can remember 73 and 74. Now, there were real macro reason with an oil shock, but stagflation is a real ugly problem because everything goes down. Yeah. And there's no place to hide except cash. And even cash, because of inflation, you lose money. And I think you saw the price of gold reacting to this. And so if you use my frame of mind, then I think it sort of makes sense. It's not a pretty picture, and I think the market corrected pretty quickly and said, you know what, stagflation is by far not the most likely scenario, but the odds of a recession must be slightly above 50.
Do you agree stagflation not likely?
Yes.
You
Not
agree
likely.
It's not likely. Okay.
It's not likely.
Got it.
I think stagflation is the nightmare of all central banker.
Yeah.
And most of them haven't seen it. You have to remember that market participants, there's only one good thing about being old, is you've seen market cycle.
Yeah.
And, I remember, for example, the 91-92 crisis with the SNL, we had the Milken Conference, people had bought a lot of high yield debt, and some of it had to sell. So you remember that. You try not to make the same mistake. You remember 1998, you remember 2001 and 2002. And of course, you remember the great financial crisis. And each crisis is different, but you have a frame of reference where you've seen ups and downs in the financial markets.
I want to talk specifically about your business. And I mean, you've got a big private credit business alongside the public credit business. And we've been talking a lot over the last couple of days about how all these markets seem to be overlapping. There's sort of this Venn diagram between public markets, private markets, credit, equity, et cetera. Are they in conflict with each other, or are they complementing each other?
I think they complement each other, but they may not offer the same value at every point in time. So I'll give you a very simple example. There's a reasonable case to be made that we have a probability of a recession slightly above 50%. If that's the case, you don't want to own high yield credit, and you probably don't want to own direct lending. Yeah. Why? Because the company are leveraged, they are weak single B, they may or may not be in the industry you want to be in, and so if you have a recession, you'll see losses. By the way, losses are normal. It doesn't mean there's anything wrong, but when we think of optimizing our portfolio, we find better opportunity to invest than the weaker credit at this stage of the business cycle.
And in making those decisions, I mean, you referenced just a second ago about all the folks who have to figure out where the dollar's going to go. I assume that there's got to be a big technological component to that. And when you took over back in 2016, you made a big push to add more technology resources to what you guys do. And given what's transpired over the last few years with AI and the newfound interest in that space, I'm wondering how much of that has become a component of the analysis and decision-making process?
A very large one, and that's a very good question. If you think about it, what do we want? We want great people to work for Pimco and to stay for as long as possible. And then we want the best technology and the most innovative quant, and marry the two together and hope that it works. And the AI revolution for us is the ability to manipulate a lot of data coming from very disparate sources, analyze them, and get to a tool to help making decisions, which is incredibly granular. So we are a very, very big player in mortgages. Everyone has a mortgage somewhere. Yeah. We have a totally unique database. And what I mean by database is not only numbers, it's picture, it's location, it's conversation with the mortgage broker. And so you get an edge because you have an ability to crunch through an enormous amount of data and get to another granular level of decision that our human brain would need longer to be able to do.
His would go pretty quickly. No, I'm just going to tell you.
He's very fast.
He's very, very fast. Manny, so thoughtful, so helpful. Thank you so much for us and for our audience. Really appreciate it. Manny Romaine, the Pimco CEO.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Carol Massar, along with Romaine Bostick. Private credit, we tend to talk about that a lot here at Milken. It's grown rapidly in recent years to become a $1.6 trillion industry. That expansion and relative lack of regulation, though, has fueled some concerns about the quality of private credit loans if the economy deteriorates, which begs the question, amid all the talk about a possible U.S. recession, or could it be stagflation, might we be getting there? Kencel has invested in numerous credit and economic cycles. He's laughing at me right now. He is the president and CEO of the global private debt manager, Churchill Asset Management, the along its sister company, Armen Asset Management. Comprises Nuveen Private Capital. I'm trying to get through it. $78 billion.
That's a long intro.
Can't you just have one name? $78 billion private capital. You are the OG when it comes to private capital. You were laughing at the introduction. Why? Because you don't think?
No, it's very simple. It's Churchill, right? That's what people know me as, Mr. Churchill, so I'll take that. Yeah.
Hey, listen, I think it was roughly, let me just look, 2 years ago, you talked about the golden era of private credit. We always bring it up right now. Is it still golden? Is the shine off a little bit right now? How would you describe it?
I would say still very much so. I mean, if you think about the dynamics today, we were on a roll, right? Third quarter, fourth quarter, first quarter, activity coming back, interest rates stabilizing, everything looked fantastic. We had a record quarter of deployment, capital raising, everything going great. And then, of course, we had Liberation Day, right? But what's interesting about Liberation Day is that it's actually creating a further opportunity for private credit. But if you think about the dynamics, when the public markets close and go offline, that creates opportunity in private credit. And unlike the GFC, where there really wasn't a private credit market to step in, there was private equity, but not a lot of private credit. Today there is. I mean, if you look at the largest managers like ourselves, we have $13 billion of dry powder. Very much open for business, very interested in providing that capital. Now, we haven't yet seen a widening of spreads in the private credit market yet. I know the BSL market is basically closed and secondary spreads have widened out a bit. But I think what you're going to see if this environment continues, and I suspect it will, at least for a short period of time, is that private credit will take advantage of those opportunities.
I'm just curious. So, I mean, what do spreads look like in the direct lending space? And I know it's probably very specific to each individual company and scenario, but I assume those had to have widened out.
You know, interestingly, Romaine, they have not at this point. But what has narrowed in are the companies that are getting financed, right? So A-plus credits with little to no tariff impact, yes, still very much being financed. In fact, we didn't have a single deal that, as we went from March to April, that actually went on hold or was otherwise pulled back. So I would say spreads have not yet widened in private credit, but the kinds of deals that can get done have narrowed, right? Higher quality gets done, tariff impacted, not really.
All right, but the uncertainty of the past month maybe increases the need for some firms, right?
Yes.
To reach out to someone like you guys.
Yes.
So were you busy post April 2nd?
We've been very busy. In fact, we've been
busier, like as a result of what happened with the tariff news?
What we've seen are larger companies that would have gone to the syndicated loan market or the BSL market. That market's essentially closed.
Yeah.
So what we're seeing is they're coming to private credit managers and saying, look, can we club you guys up? Can we get 2 or 3 direct lenders to do $1 billion financing?
So it's bigger
$2 billion?
companies.
Somewhat larger companies, which is typically what happens. And overall, what we should see is generally wider spreads. Today, you asked the question, where are we today? Probably SOFR 500 or so. Okay. Things really haven't widened out that much, but I think you will see spreads widen out. I think you'll see leverage come in a bit. And of course, you'll see our good friend, the covenant, come back in vogue, which we like to see.
What do those look like?
In our world, we see them, right? Yeah. But I would say, as a general matter, in the liquid markets, not so much. So I think it opens up larger deals. It opens up deal flow that enables us to step in. It's interesting. If you look at the GFC, there was plenty of private equity, but the banks weren't lending, and there was no direct lending. Today, tremendous amount of dry powder in direct lending, still a lot of dry powder in private equity. So I think things will normalize. And frankly, from my perspective, I don't think we're going to see an extended period of this tariff dynamic. I would expect that it'll play out in a reasonable period of time and hopefully shorter rather than longer. And obviously, the longer it goes, the worse
I'm curious when you say that then, if you're looking for new opportunities, I mean, a lot of people have said, okay, we're only looking for companies that, domestic companies or companies that don't have a lot of international exposure or tariff exposure. Is there an argument to be made that maybe you should be looking at those names, assuming that their valuations might have come down because of the tariff pressure?
Yeah, well, I would say maybe, but not for us. Okay. I mean, I would say, here's an interesting stat. 92% of our borrowers today, we have about 600 companies in our portfolio, 92%, no impact, no tariff impact at all.
Wow.
So private credit, by its nature, is mid-market U.S. companies that tend to be more domestic, that tend not to be as international as maybe some of the large cap businesses are. So in that
primarily
sense,
services businesses?
Services, healthcare, software, business services that tend to be more domestic.
But you're picky in terms of who you choose.
We're really picky.
I mean, that percentage is impressive, but I'm just saying, you're really careful with who you pick.
No.
I'm sorry, go ahead.
And as a general matter, within that, we tend to focus on those, those sectors that are less impacted.
Real quickly, Ken, we're running out of time. I just have to ask you, though, going back to the origin of this conference, which you sort of chuckled, you were here, 1998, whenever that was here.
Yeah.
The evolution of this. Is this an evolution or is it just growth?
It's absolutely an evolution.
Yeah.
And I would tell you, changed in a number of ways. Early days, it was more of a policy conference. It's retained that policy, which is great, and I think attracts a broader audience. But the investors are all here, right? And they're all looking to talk about their stories, and they're exchanging ideas with each other. I was saying earlier to both of you, some of the most interesting conversations I've had here have been the one-on-ones with other investors.
Yeah.
We don't get to see each other very often, right? We're all on the road raising money, but we're all here, right? So it's an opportunity to share ideas, think about, okay, have we thought about different angles from an investment standpoint? So in that way, it's really evolved quite a bit.
All right, Ken, we have to leave it there. Always a great pleasure.
Wait, you don't want to have him share one of those deals, those ideas on the side?
I don't know. My producer's in my ear telling me I should have wrapped like 10 minutes ago. But
wait, you listen? You actually listen?
Sometimes I listen. Ken Kencel, Churchill Asset Management, President and CEO.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We talk about median home prices now approaching almost 6 times the U.S. median income. Meanwhile, if you're renting, you're spending more than a third of your income on rent. So it's kind of a weird squeeze. Last year, Airbnb formed a council of experts chaired by the former mayor of Baltimore, Stephanie Rawlings-Blake, to advise the company on initiatives to boost housing supply and drive down prices. Pleased to say the mayor, Rawlings-Blake, joins us right here on the Milken stage. Good to see you, Stephanie.
Thank you for having me.
Housing affordability is something people have been trying to solve probably for decades, maybe even longer than that. A lot of the topics that came up, or the responses that came up, really talked about the emphasis of more government involvement in pushing this forward. Are we seeing that?
We're definitely seeing it, but one of the things that I took out of the panel that we had is that it's going to take all of us, right? Airbnb understands, for example, that they're not the cause of the housing supply shortage, but they can be a part of the solution. As a mayor, I knew that I didn't cause it, but I had to be a part of the solution. And some of the developers and private equity folks that were on the panel, they have to understand that they have to be a part of the solution as well. So it's an all hands on deck. We talked on the panel that we're short in this country over 5 million homes. And we're not going to close that gap by doing what we did yesterday or a decade ago. We have to think critically and with more innovation around how to build more, how to build faster, and how to build better.
How does the city, though, grapple with economic growth, similar to what Baltimore went through, where you had this huge resurgence, companies coming back, people moving back to the city? Of course, that also drives up, typically, real estate prices as people look for homes. So there's a balance, right? You want to, reap the fruits of getting all those people back into your city, but at the same time, you don't want to shut everyone out who maybe isn't at a certain income level. Where's the balance?
So I always look for the win-win. And when you talk about bringing people in, that's always a good thing. But in Baltimore, like many cities, we have a circuit breaker, meaning the value of your home year over year could go up 100%, but your property tax will only go up a fraction. And that allows people to stay in their homes and reap the benefit of wealth creation through their home. But there are also things like repurposing vacant homes. I think we need to think differently about vacant homes. Yes, they're a blight, but they're also an opportunity. When home ownership is so far out of reach for many of America's young people, we can look to rebuild and these vacant homes as a way, because the infrastructure is already there, right? Cities like Baltimore were built for, over 1 million people. So that infrastructure is there, the people aren't there. So how do we look at those vacant homes as opportunities for families and young people to become homeowners?
Stephanie, I love that you went there, because I think people are like, just build homes, build the 5 million homes. It's not just about building them anywhere. It's about building them where people need them. And they tend to be cities which tend to be expensive. So as soon as the build happens, it's often expensive. How do we fix that? How do we get developers, politicians, everyone to say, let's build where the housing is needed and let's make sure we make it affordable? How do we do that?
So cities like Baltimore are incentivizing affordable housing, incentivizing repurposing vacant homes.
Right.
That was one of the projects that I started as mayor, my Vacants to Value program that our current mayor has taken on and made it his own. So we need to do things like that, where we're creating incentives like down payment assistance. The president of Johns Hopkins is speaking here at Milken. They give employees like match for match. Like they're giving their employees thousands of dollars in down payment assistance if they move around the university. So things like that. And we have to look for innovative ways to promote financing of these affordable housing as well.
Do you feel like all the right stakeholders are at the table talking? Because sometimes, no. Who's missing?
I think you have to look at the job creators. On the panel today, we talked about a teacher in a public school having to commute an hour and a half, right? Mm-hmm. That is atrocious. No teacher should have to commute an hour and a half to get to the classroom. So the Board of Education should be at the table, the hospitals, the universities, all of these people, the companies, the people who are employing America's citizens should be at the table to be a part of the solution. Everyone has a different role to play, like Airbnb. Like Airbnb supports grassroots organizations that are doing things like fighting zoning laws that prevent housing, that work with cities to reduce bureaucracy, make it easier for buildings to happen across the country. That's what Airbnb is doing, their part. But every company that has employees could be doing something.
Great point.
All right, Stephanie, that was a great conversation. It was good to catch up with you. I had to fly all the way to LA to catch up with you. We'll get back to you.
Good luck.
When we're back on the East Coast. Stephanie Rawlings-Blake, Airbnb Housing Council Chair and the former mayor of Baltimore. We should also point out, she mentioned Johns Hopkins. Of course, Mike Bloomberg is a big contributor to Johns Hopkins. He is the owner of the company that owns the network that you're watching right now.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
And while we have seen spreads in the U.S. high-yield bond market actually down from that big spike that we saw in early April, they do remain elevated, and so too does the volatility. And in the less liquid world of private credit, direct lending spreads do sit just a touch wider, although we don't know quite how wide for obvious reasons. But that has left some money managers much more selective about adding risk. Here to discuss those correlations and the dislocations is Armen Panossian. He's the co-CEO over at Oaktree, $200 billion in assets, mainly in credit. Great to see you, Armen.
Great to see you both.
Are you buying right now?
Carefully. Mm-hmm. We are mindful of the exposure to tariffs. We are mindful about the potential retaliatory tariffs. We think there's some good value out there, especially in public credit, but we are also recognizing the fact that we may be on the precipice of some volatile times ahead.
What are credit spreads telling us right now? We had that brief spike in early April, and I know we're still elevated, but we're nowhere near the types of blowouts we saw during past financial crises.
Correct. We're at about a 360 spread in U.S. high yield. Mm-hmm. If you look at the high and the low over the last 6 months, it was 260 and 460, so we're right in between. So you have to ask yourself, has the news been supportive of being sort of right in the middle there? I think the second and third quarter numbers as they come out, however, could suggest that 360 is a little bit on the tight side, to be honest with you.
Armen, I guess what we have to do is kind of accept the reality, though, that, all right, here we are, this moment in time, but 24 hours from now, it could be very different based on what's coming out of the White House. So when you say precipice of a volatile time, I mean, that's the reality of it. What would happen to make things settle down? Is it a tariff agreement with U.S.-China? Like, what is it in particular?
I think it's exactly right. If President Trump decides very, very soon that there is a reasonable resolution with China in particular on tariffs, then I think there's a relative calm that will persist in the economy and the markets, and companies will be able to know what to do next. For now, what's happening is there's a delay in spending, consumer spending, capital expenditures. As that continues, it could cascade into unemployment. And that's the sort of the really negative outcome here if this negotiation takes much longer.
All right, so if they get a deal, and it is a little bit more onerous in terms of tariffs between the two nations, is that kind of okay as long as we know the terms, or the terms do matter as well?
The terms do matter because whatever the tariffs are, let's say it's 60% on China and 20 or 30% for the rest of the world, that's still inflationary.
Right.
And so the question is, what's after that? And Secretary Bessent mentioned sort of a three-pronged approach. There's tariffs, there's taxes, and deregulation. So the question is, does the deregulation and do the lower taxes offset the impact, the inflationary impact of tariffs for consumers or not? If it doesn't, then there could be demand destruction and some economic issue.
So Bloomberg reported last month that Oaktree was setting up another special situations fund, trying to raise money for that. Are you able to share any thoughts on the progress of that?
Well, we can't talk about any particular fundraise, but we do see a lot of opportunity for companies in need of both equity and debt to help them bridge through uncertain times. We are seeing more activity in terms of companies calling us for rescue loans. I know others have mentioned that as well. I expect that given what's happened with the policy backdrop, and private equity firms had hoped to be able to sell out of their businesses earlier this year. It was supposed to be a really strong year for M&A. But given what's going on now, I think that those same private equity owners will have to come to the likes of Oaktree for some solutions that help to extend their ownership of those businesses.
Has there been discussion, not just at Oaktree, but just amongst your peers as well, in the private capital space about trying to find ways to increase liquidity, or at least have the flexibility to increase liquidity should times really get hard?
In terms of in liquidity in the asset class, I think that's very hard to do.
Yeah.
Now, the reason is in below investment grade credit or unrated credit, the borrowers want their financials to be not in the public domain. You need those financials to be in the public domain to be able to increase liquidity and transparency in the trading of those assets. In investment grade private credit, because usually the borrowers are already publicly traded, it's easy to triangulate to the value of a privately issued credit to a publicly traded company.
What are the geographical variations and differences that you're seeing, or dispersions? Europe has been a topic we've been talking about a lot here at Milken. Talk to us about that, if you would.
Well, we're not seeing a tremendous amount of dispersion yet, but what we are seeing, however, is our clients globally are wondering whether they need to back off on how much exposure they have to the U.S.
They really are asking.
They are asking. They know that the U.S. is still the best place to invest. It's the deepest market, strongest economy. But the question is, has the U.S. damaged itself in some for an intermediate period with some of the policy statements we've made? And if that's the case, should we, a non-U.S. LP in particular, should we be looking at other parts of the world, like Asia or Europe? In Europe in particular, there are some tailwinds, and the tailwinds being stimulus around defense especially, and infrastructure relating to defense. A lot of capital is going to be spent. Debt to GDP in a country like Germany is low enough that there could be some additional debt taken on by Germany to fuel this type of build-out. It's probably a good time to think about asset allocations a bit.
With regards to some of that allocation that we're seeing to Europe, is that concentrated, though, around defense, or at least around industries that would be a direct beneficiary of that increase in fiscal spending?
I think it's too early to tell, but I would say it's the point of focus is in general industrials, and that is a first order and second order, or it depends on defense on a first order and second order basis.
Do you think we'll see much more of an opening of the European market to private capital, private credit, private equity? That they didn't necessarily chase the U.S., at least not to the same scale that we have here. Do you see the potential for that market to actually expand?
I see it. I see the potential to expand. I think the size of the borrowers in Europe, however, just tend to be smaller. The market is smaller. I don't see it becoming the size of the U.S., but I do see it growing from its current status. I think the hard part is for European LPs, for European investors, there is a different regulatory dynamic that requires them to really favor European investment, and they're not finding enough to do right now. They have a lot of capital and not enough places to put it in Europe. So the market does need to expand. The question is, will there be enough businesses of size and scale and giving depth to that market for deployment in the region?
Armen, when you said that some of the investors were saying, should we reduce our exposure to the United States, by how much? Are they just saying a little bit, or are they looking to say, do I need to be a little bit more aggressive outside the U.S.?
For now, it's by a little bit.
Okay.
Right now, most non-U.S. investors have something like 50 to maybe as much as 70% of their portfolios deployed in the U.S., private equity, credit, of a variety of types. They're not talking about cutting that in half, but 5, 10, 15% could be on the table.
That's
for some of them.
significant. Hey, last question. Milken, I feel like from year to year, the mood, the narrative can change. It feels like everybody's here trying to figure out what's next. Yeah, there's always a part of that, but I'm just curious what's striking you about this year's conversations.
It's a good question. I think because the S&P is back to sort of Liberation Day levels, I'm not surprised to hear that some people are probably a little bit more optimistic than that there will be a deal cut. I'm surprised to hear that there's a belief that that sort of rationality or rationalism will prevail and that we'll get to a deal on the tariff side that is acceptable to U.S. companies in a reasonable enough period of time to avoid a bad outcome. Well, I don't think that's off the table. But I don't think that that's the likely outcome. And I think that the mood shifts depending on whether you're talking to U.S. investors or non-U.S. investors. U.S. investors are quite U.S.-centric and they believe everything will be fine. Non-U.S. investors are a little bit more concerned because they are, frankly, a little bit more culturally sensitive to what our trading partners now think of us. That's a sobering kind of dichotomy in terms of conversations that I've been having over the last few days with our client base. And it gives me pause. It gives me reason for real concern that we're going to have some troubled times economically, which will then eventually create some opportunities to invest in the markets.
Well, Armen, if we are fortunate enough to catch up with you 12 months from now, it'll be interesting to see if that mood has actually changed or not. Great to have you here, Armen Panossian, the co-CEO over at Oaktree.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.